RJTI, charts algorithms idea with SPACEX and the structural market risk, precious metals outlook, and portfolio defense. RJTICharts.com. Over the last 42 years, our methodology, algorithms, have led us through every major move when it comes to markets. Here's our truth, which is documented, and keep in mind, many have an idea when to can buy, and we've identified bull runs for the stock market on several occasions. But what we have proven to be a strength of ours too is knowing when to sell, and most just don't know until it hits them. Our signals were typically ahead of most, and feel free to go and examine the charts for the DJ30, SP 500, NASDAQ 100, our sales signals. The 1st of January 2000 tech bubble burst. The 30th of November 2007 housing bubble. We watched Jim Cramer 2008 almost lose his mind on national TV. The 31st of March 2015 flash crash, 101-22018, Christmas crash. The 1st of January 2020 pandemic crash, warned 9 months before that a black swan event was to unfold. The 1st of January 2022 bear market crash. The 5th of February 2024 post-election exhale. The 6th of February 2025 Trump tariff crash. The 4th of February 2026 Iran oil correction, geopolitical shock. The 5th of June 2026 new sell signals generated. You must agree that one would be unwise to declare the sell signals and not be able to prove them, right? We have the receipts. So here's our take on SPACEX. And yet, please follow your own trading ideas, investment ideas. Executive summary. The upcoming debut of SPACEX, SPCX, highlights structural vulnerabilities in today's market. At a $1.77 trillion valuation, this offering marks a period of significant equity overvaluation. The broader stock market currently carries an estimated 35% valuation premium accumulated since 2023. This makes it highly sensitive to sudden corrections. This briefing analyzes the immediate structural threats to the market. It outlines a defensive transition into US 30-year Treasury bonds and maybe the 10-year T-note. It also presents a long-term strategy for precious metals as safety assets, equity market vulnerabilities, and the tech hype. The upcoming launch of mega-cap IPOs is shifting liquidity out of existing holdings and amplifying systemic risk. The SPACEX valuation disconnect. The $135 IPO price values the company at 94 times its 2025 revenue. Independent analysis, including data from Morningstar, suggests a fair value closer to $780 billion. This indicates a 55% premium driven primarily by hype. Target correction floor. We project a correction bringing the stock down to $85 per share. This level represents a more sustainable valuation of 59 times revenue. The impending liquidity drain. Large institutional funds are actively selling secondary shares to build capital for SPACEX. This trend is expected to create selling pressure on other mega-cap companies. Unfolding macroeconomic catalyst scenarios. A broad market correction could be triggered by two distinct types of systemic shocks. Gray swan events, black swan events, known, underpriced, unpredictable, shock. Valuation bubble burst, geopolitical conflict, domestic, fiscal, stress systemic credit freeze. Persistent inflation infrastructure failure. Gray swan events, known, underpriced risk, valuation bubble burst. The sudden removal of the 35% premium added to the market since 2023. Domestic fiscal stress. Sharp volatility resulting from rising sovereign debt levels and shifting monetary policies. Persistent inflation. Stubborn economic indicators forcing central banks to maintain elevated interest rates. Black swan events. Unpredictable shocks. Geopolitical conflict. Sudden escalations that interrupt vital global trade paths. Systemic credit freeze. Unforeseen liquidity failures within key banking or private credit networks. Infrastructure failure. Disruptions to global logistics networks or digital technology systems. The defensive strategy, moving to safety. To mitigate these equity market risks, we recommend a tactical transition toward defensive assets. U.S. Treasury bonds. Long-term treasuries provide clear capital protection. They are positioned to gain value as capital leaves the stock market during a correction. The flight to quality. We anticipate institutional asset reallocations to move capital out of overvalued equities and into high-grade debt instruments. Precious metals. Long-term outlook. Precious metals provide a strong hedge against systemic risk and currency devaluation during market corrections. Gold. XAU. Short-term support floor. We expect gold to find a solid long-term bottom around $3,000 per ounce. This level represents a healthy correction to clear out speculative market positioning. Long-term target range. From that base, structural deficits and safe haven demand are projected to drive gold toward a new target of $6,000 to $8,000 per ounce. Silver and platinum, XAG, XPT. Silver target. Silver is expected to follow gold's trajectory. It should outperform on a percentage basis due to industrial demand, aiming for a target range of $75 to $100 per ounce. Platinum target. Driven by supply deficits and its role as an industrial hedge, platinum is positioned to recover its traditional premium and target $1,800 to $2,400 per ounce. Asset class expected correction, floor long-term target range primary demand driver. Gold Oz, $3,000, $6,000, $8,000. Safe haven accumulation. Silver Oz, $28, $75, $100. Industrial green tech demand. Platinum OZ, $900, $1,800, $2,400. Supply deficits and auto catalysts. But time holds all truths. Get your Ramo today. It is easy to see the trees that make up the forest, and it's even easier to see the forest that's made up of trees, but it's not so easy to see behind the forest.